Welcome back to this video where we will be delving into the fascinating world of reversal candlestick patterns. So what exactly do these reversal candlestick patterns signify? Well, they represent a shift in the prevailing trend. For instance, if we have been experiencing a downtrend and there is an upcoming change to an uptrend, these patterns can give us essential clues. These indicators manifest in the form of candlestick patterns, and their significance becomes apparent when they appear at either support or resistance levels. Remember, resistance lies above the price and support lies below it. Now, let's take a closer look at these candlestick patterns. First up, we have the spinning tops. These little guys have a distinctive appearance like this example right here. A spinning top typically boosts long upper and lower wicks with a small body in between. It is essential to grasp that when we spot these candlesticks, neither the buyers nor the sellers had a firm grip during the trading session. If a spinning top emerged during a downtrend, it often suggests that there are relatively few sellers left in the market to keep driving the price lower, opening the door for potential price stalling or even a reversal. Let me demonstrate this with a real life example. Here is a spinning top right here. In this scenario, we witnessed a downtrend until we reached this point, but the appearance of the spinning top indicates that sellers are losing steam and buyers are entering the market, likely heralding a change in trend. The same principle applies when we encounter a spinning top during an uptrend. It implies that there ain't many buyers left to propel the price higher, resulting in a price correction or downtrend. However, it is crucial to remember that spinning tops may appear between charts, and in such cases, they don't hold any significant meaning unless they are at support or resistance levels. Now let's move on to the Marubozu pattern. This one signifies substantial activity from either the sellers or buyers in the market. When we encounter a red Marubozu, it indicates a surplus of sellers causing the price to go down. Conversely, a bullish Marubozu represented by green color suggests that the buyers are in control, potentially leading to an upward price movement. A green Marubozu signifies that the opening price coincides with the low price, while the close price aligns with the high price, indicating minimal price fluctuations during the trading session. Next on the list is the Doji pattern. A Doji emerges when the securities opening price and closing price are nearly identical, creating a visual representation of the struggle between buyers and sellers during the session. For instance, this is a typical Doji right here. When the opening and closing price are equal, it means the price neither went up nor down during the trading session. Here is a critical point to keep in mind. When we encounter a Doji in a downtrend, it signals a potential bullish reversal, and if it appears during an uptrend, it hints at an impending bearish reversal. Additionally, there are various types of Doji patterns, but they all serve the same purpose, indicating a change in trend. Now let's discuss the hammer and hanging man pattern. Hammer represents a bullish reversal candle pattern that appears during a downtrend, typically at support. When you spot hammer at support, it's an indication that buyers are becoming more active, suggesting a potential uptrend. Conversely, when we see hanging man in an uptrend, it represents a bearish reversal, implying a potential shift to a downtrend. While the properties of hammer and hanging man are similar, the crucial distinction lies in the context of their appearance. We have the inverted hammer and shooting star patterns. Inverted hammer is a bullish reversal pattern that manifests during a downtrend, specifically at support. It is recognizable by its long upper wick, often around 2 times the length of the body. Conversely, the shooting star appears during an uptrend and foreshadows a potential downtrend in the near future. But these patterns can provide valuable insights into upcoming trend reversals. Next up, we have the bullish engulfing pattern. This pattern is quite common in the market and typically occurs during a downtrend. When you spot a bullish engulfing pattern, it means that the green candle size is larger than the preceding red candle in a downtrend. This signifies a potential uptrend as the buying activity in the green candle outweighs the selling activity in the red candle. In other words, there are more buyers than sellers in the market, leading to an upward price movement. It is important to note that this pattern is most valid when observed at a support zone, indicating a significant level of buying interest. When you find a bullish engulfing pattern in between charts or other locations, it may not carry the same significance. Now let's examine a real-life example of a bullish engulfing pattern. Imagine we had a clear downtrend from one swing high to another swing low. Following this downtrend, we encounter a red candle. Right after the red candle, we witnessed a green candle and the body of this green candle is larger than that of the previous red candle. This fulfills the criteria for a bullish engulfing pattern we discussed earlier. Consequently, the price is likely to move upwards after the formation of this pattern. Next, let's talk about the bearish engulfing pattern, which is essentially the opposite of the bullish engulfing pattern. In this case, during an uptrend, you will be on the lookout for a red candle with a body larger than the following green candle. The bearish engulfing pattern indicates a potential reversal from an uptrend to a downtrend. You can find this pattern most effectively at resistance levels, which represent supply zones. Here, sellers outnumbers buyers, leading to a probable price drop. Let's observe an example of a bearish engulfing pattern in a real market scenario. Suppose we add an uptrend from one swing low to another swing high. Following this uptrend, we encounter a green candle. Subsequently, we see a small candle, which could be a doji or a spinning top. Finally, we witnessed a red candle with a body larger than the previous green candle. This completes the criteria for a bearish engulfing pattern, suggesting a potential shift from an uptrend to a downtrend. As a trader, you may consider taking a short position at this point to capitalize on the expected price drop. Now, moving on to the dark cloud pattern, which bears some similarity to the bearish engulfing pattern. In the dark cloud pattern, the red candle covers at least 50% of the preceding green candle during an uptrend. This particular pattern is a bearish reversal signal indicating a potential shift to a downtrend. You should be on the lookout for dark cloud patterns at resistance levels, as sellers tend to dominate at this point, leading to a probable price drop. Let's examine a real-life example of a dark cloud pattern. Picture an uptrend from one swing low to another swing high. Following this uptrend, you will notice a green candle. Next to it, you will find a red candle that covers more than 50% of the green candle. This fulfills the criteria for a dark cloud pattern, implying an impending shift to a downtrend. As a trader, this would signal a potential opportunity to enter a short position and profit from the expected price decrease. Moving on to the piercing pattern, which is quite similar to the bullish engulfing pattern, but with a slight difference. In the piercing pattern, the green candle doesn't entirely cover the preceding red candle. However, it covers at least 50% of the red candle's body during a downtrend. This pattern serves as a bullish reversal signal, indicating a potential shift from a downtrend to an uptrend. You should look for piercing patterns in a downtrend, especially at support levels where demand is likely to overcome supply, leading to an upward price movement. Now, let's take a look at a real-life example of a piercing pattern. Imagine a clear downtrend from one swing high to another swing low. Following this downtrend, you will come across a red candle. Next to it, you will find a green candle that covers more than 50% of the red candle's body. This satisfies the criteria for a piercing pattern, suggesting an imminent shift to an uptrend. As a trader, you may consider going long at this point to capitalize on the expected price rise. Next, let's discuss the Morningstar pattern, which is a 3-candlestick reversal pattern. This pattern consists of a large red candle followed by a small doji or spinning top candle, and finally a strong green candle. The third green candle must cover more than 50% of the first red candle. When you spot a Morningstar pattern in a downtrend, it represents a bullish reversal signal indicating a potential shift to an uptrend. Look for this pattern as support levels for the most reliable indication. Now, let's examine a real-life example of a Morningstar pattern. Suppose we have a downtrend for one swing high to another swing low. Following this downtrend, you encounter a large red candle. Next to it, you will find a small doji or spinning top candle. Finally, you will see a strong green candle that covers more than 50% of the first red candle. This fulfills the criteria for a Morningstar pattern, suggesting an imminent shift to an uptrend. As a trader, this will signal a potential opportunity to go long and profit from the expected price increase. Now, let's talk about the evening star pattern, which is the opposite of Morningstar pattern. In an uptrend, the evening star pattern consists of a large green candle followed by a small doji or spinning top candle, and finally a strong red candle. The third red candle must cover more than 50% of the first green candle. When you spot an evening star pattern in an uptrend, it indicates a bearish reversal, signaling a potential shift to a downtrend. You should look for this pattern at resistance levels, as they represent supply zones with a higher likelihood of price drops. Although it is challenging to spot evening star patterns and Morningstar patterns in a real-life market scenario, It is essential to remember their significance. When found at the right locations, they can serve as reliable signals for potential trend reversals. Lastly, let's discuss the tweezer top and tweezer bottom patterns. A tweezer top pattern occurs when the highs of two candlesticks occur at the same level, indicating a potential bearish reversal in an uptrend. On the other hand, a tweezer bottom pattern occurs when the lows of two candlesticks occur at the same level, suggesting a potential bullish reversal in a downtrend. Keep in mind that these patterns are most effective when observed at resistance levels for the tweezer top and support levels for the tweezer bottom. In summary, these candlestick patterns serve as valuable tools for traders to identify potential trend reversals and make informed trading decisions. By recognizing them in real-life market scenarios and understanding their implications, you can improve your trading strategies and increase your chances of success. Remember to always consider other technical indicators and perform thorough analysis before making any trading decision.